So in the first lesson, we're going to try to learn how to trade using the Fibonacci retracement tool for trading Forex. This can be used for trading multiple currencies. I normally like to trade the US dollar and the pound. It works quite well with that currency pair. So the first step here is to identify the support and resistance level. So you see the market and then you try to identify the support and resistance levels. So the support level in this case, these are all the support levels. This is what the market hits, bounce back up, and this is the resistance level. It's like the roof. The market hits that and then comes back down. We try to identify the trend. In this case, the market is going up, so we call this an uptrend. In this strategy, once you identify the trend, you wait for the price to break the trend line. Once the trend line has been broken, you want the low that needs to be formed to be lower than the previous low. This is the previous low in this case. So you want the market to come down and break this low. The market does that, and then you want to identify the lowest low and the highest high. Once that is done, you want to draw the Fibonacci retracement tool from the highest high to the lowest low. The market's going to bounce back up and hit a Fibonacci level. In this case, it's hitting this Fibonacci level, which is 62%. You wait for the market to hit the 62 or the 79% Fibonacci level, and you want it to form a high. A high in this case is defined as a point where you have two candlesticks to the left and two candlesticks to the right. So, two candlesticks to the left and two candlesticks to the right. Once that occurs, you want to sell, place a sell order at that point. You're going to set your stop loss at the highest high and take profit at the Fibonacci extension level. That's going to be your risk, so you're minimizing risk by using this strategy. We call this trading a crown, where you have the head and then the shoulders. So the uptrend in this case becomes a downtrend later on. Some of the key points: you want the trend to break, so it must form a low that's below the previous significant low. You want to draw the Fibonacci retracement from the highest high to the lowest low in an uptrend. It's very important that you wait for the market to hit the 62 or the 59% Fibonacci level. You want to do this to minimize the risk. You don't want to be going into risky trades. If the market hits 50%, do not trade, because this is going to be a very risky trade. A high is formed when you see two candlesticks to the left and two candlesticks to the right. You're going to enter by selling. You're going to set your profit and stop losses. Your stop loss is going to be the highest high. Profit is going to be 30 pips, or risk, whichever is greater. And if the risk is too great, you don't want to go on the trade. You always want the market to hit either the 62 or the 79% Fibonacci level. Here's an example. This is an uptrend. We have identified the support and resistance levels. These are the levels that the market's hitting and bouncing back up. It's a nice uptrend. So in this case, we're going to draw the Fibonacci from the highest high to the lowest low. That's the low and that's the high. You wait for the market to bounce back and hit the 62% level. Once that's done, you sell. So you're selling at about here, and then the market goes down and gives you a nice profit. Another example, in this case it's another uptrend. Then you're drawing your Fibonacci from the highest high to the lowest low, and you're doing that only when the low is lower than the previous low. Then you're waiting for the market to bounce back up, and this time it hits the 79% level. Once that's done, you want to go in short, you want to sell, and then wait for the market to move back down and take profit. Your stop loss in this case is going to be the previous high.